In this week's video, we'll review the latest charts to help us answer the question, did the Fed just open the door to a recession and lower lows in stocks? We've got a lot to cover, so feel free to use the pause button on your video player. This piece on the right side of your screen from Bespoke, dated Wednesday, August 24th, has a sentence that does a good job summing up 2022. No matter which way you cut it, 2022 has been the worst year of the past half-century for stocks and bonds combined. It's a daily DeMark chart of the S&P 500 index. DeMark charts and indicators are proprietary tools from Market Studies, LLC. This is the S&P 500's 9 and 13 exhaustion count here, making a stand here in June and July. These propulsion diamonds here were all the way down around 3,400 not too long ago. Now they've moved up to 3,825, an area of possible support. And the upside propulsion diamond sits at 4,401, and price is still above an upward sloping 50-day moving average shown here. For clients, let's start with some tactical notes. We had 3 positions on Friday in terms of their average cost basis that were still profitable. Given the data's deteriorated in a somewhat alarming and rapid manner, we made sure those 3 positions didn't slip into a loss, allowing us to reduce our overall risk exposure. Over the past few weeks, we've covered numerous rare breath signals that are typically associated with major lows in the S&P 500. In most of the historical cases, the average and median drawdowns were relatively tame, especially compared to historical performance looking out 1 and 2 years. It's pretty convincing evidence when you have an average gain 1 year out of 25.34%, with 98% of the cases positive a year later. Also encouraging to see 39.25 2 years later, with 100% of the cases higher. All of this obviously very, very positive a week ago and even 2 weeks ago. But you may remember these were the bullet points that we used to close last week's video, basically reminding us that it's prudent to make no assumptions about what tomorrow is going to look like. And as we noted last week, it's important when we're looking at market-generated signals in history to understand that yesterday's news is a sunk cost. And as we noted last week, if the data shifts significantly, we must reassess the odds. So where do we stand relative to the average and median drawdown in these historical cases? When the S&P 500 closed on Friday, August 26, we're sitting right in between the average and the median drawdown. So in terms of price, and even in terms of time, really haven't seen anything yet that's too alarming. As you might imagine, there's some howevers coming later in the video. This is also a good sign. This looks quite a bit different here and better than anything we've seen in the rear view mirror. Typically, when you have a big decline like this, a look like this on your 50-day moving average is worth paying attention to. So we've got 3 reference points in relatively close proximity to where price closed on Friday. As always, we're not making any assumptions that this is going to hold, this is going to hold, or this is going to hold. They're simply reference points. If the maximum drawdown occurred in a similar manner to these cases over here in the present day, the bottom of that drawdown would typically fall somewhere between August 21st and September 8th. Well, we're still in that window. Let's focus in on the cases that had the highest maximum drawdowns over here associated with this historical study. If we experience something similar in the present day to the worst drawdown here, hypothetically that says the S&P 500 could fall an additional 11% roughly from Friday's close. Let's take a look at where we stand on some of our other studies relative to historical drawdowns. This was the rare push higher where over 90% of stocks in the S&P 500 exceeded their 50-day moving average. And going back to 1942, the average gain looking out a year was 25.5%. The median gain basically the same. And if we look at the signal dates from Dean's signal, as we noted, 3 of them, January 27th, 1975, May 5th, 2003, and May 4th of 2009, all of those occurred after major lows. And last week we looked at these historical drawdowns hypothetically on a present-day chart. So typically after you see one of these rare signals, the drawdown takes you really into this band from point A here to point B up here. That would be your typical drawdown. On Friday, we exceeded that. We've got 2 cases below us here, but this does speak to odds. Wouldn't say this is a red flag at this point. Fair to say it's a yellow flag. Like anything else, the longer we stay below this band, the more concerning it would become. Another signal that we covered last week based on the S&P 500's streak above its 10-day moving average. Once again, very rare. In 3 of these cases, within the context of major bear markets, the signal occurred after the major low. Drawdowns typically were relatively muted and tended to occur relatively quickly. The median was 7 calendar days, the average was 32. Now, historically, this type of drawdown on a risk-reward basis is very, very attractive because looking out 1 year, every single case over here, the market was higher, and the average 1-year gain was 17.51%. This is the look of the drawdown chart on August 18th. Now, maybe we'd call this an orange flag because for the most part, we're down to the heaviest drawdown here as of the close on August 26th. Obviously, if the market made a stand in this area, that would be a good thing relative to keeping this signal alive from a probabilistic perspective. When you complete technical studies like this, you should be able to learn something either way. If we don't hold these levels, it starts to speak to increasing bearish probabilities. You may remember we covered this signal, large 2-quarter drops back to back. Here are the signal dates. And this would be at the end of Q2 or at the end of June this year. The historical drawdowns say it wouldn't be abnormal if price came down into this area here. Another rare signal on the left side of your screen, 1 year later, 100% of the historical cases, the market was higher, telling us it is still possible to take a longer-term view of where we are at this point. And this was the signal that we covered here. It's very, very similar to this one over on the left. And since it was the first signal within the context of this bear market, we zeroed in on the first signals. Here are some reference points relative to historical drawdowns tied to this signal here, which is very, very similar to this signal over here. This chart's dated July 22nd, and as of the close on August 26th, nothing particularly abnormal here, except this is a pretty big drawdown. If you're going to come from where we are today to 3,500-ish, hypothetically. The average and the median would take you just under 3,800 and just under 3,700 approximately. How do our scores look? Remember, this model is built to try to discern between a failed rally attempt and a successful rally attempt. Scores go from 0 to 100 July 8th, July 22nd, July 29th, August 5th, still seeing improvement on August 12th, and additional improvement as of August 16th. Intraday on August 26th, still showing some improvement. It's beyond the scope of this video to explain exactly how we would use this model, but you're not waiting for this score to get to 100. It's a scale-in model, and it's one piece of the weight of the evidence. Around 2 p.m. Eastern Time on Friday, August 26, approximately 81% of NYSE volume was associated with declining issues. A lot of heavy selling between 2 p.m. and 4 p.m., and it looks like we finished above a 90% down day. That's heavy, heavy institutional selling. And probably fair to say that that would contradict the breadth thrusts rather than align with them. And if you only saw the close on Friday, August 26th, it might be hard to believe that the market was positive for a while today. You can see this is a key short-term battle area here. We closed well below it. Now, this type of look would align with that 51 or 48% score. And what's more important relative to those models now is where do they go from here? So let's just assume, hypothetically, you're at 50 here. When you come down here, obviously your model's going to be lower, but your score is going to start to become constructive in this area here, which is your sweet spot. And if you were just to look at price and you were just to look at the drawdowns relative to the historical drawdowns, not a disaster at this point. We got an upward sloping trend line here. If we dropped like a stone, it would come in somewhere around 3,900. We've got an upward sloping 50-day moving average around 4,000. A huge gap here is a reference point, and a huge gap here is a reference point. So in the short to intermediate term, this is going to be a key battle area relative to a bottoming process or much lower lows. A lot of looks like this on Friday. You can see Bitcoin holding the upward sloping trend line. This is nothing earth-shattering, but it's really not what you want if you're bullish on this asset. You're still within this consolidation area, but if you're coming down here and breaking this box, concerns would increase. But very, very difficult to say this is a good look in the short term. NASDAQ relative to the S&P 500 still above this upward sloping trend line, looking a lot more vulnerable. But this is, again, an area of importance down here, and we'll learn something either way. At the end of the week, we can still say this looks better than anything that we've seen going backwards to Q4 of last year. And a lot like the breath thrust, you can see when the Copic curve rises from below zero and gets back to zero here and here, well, good things tend to happen. This is much more vulnerable but not disastrous looking at this point. NASDAQ still holding above that upward sloping 200-week moving average in red. And like many of the charts we've already covered, really not what you want here. We closed here below these levels up here, but we're still above this upward sloping trend line. This is a key battleground in here. So we're going to learn a lot next week and maybe over the next 2 to 3 weeks. And as we've covered numerous times, this is NASDAQ 100 stocks greater than their 200-day moving average on a monthly basis here. You can see where we are now. That's extremely rare oversold territory. And typically, that's where you find a bottom. There's one major exception here in 08-09. But even taking that into consideration, from this point here, looking out a year, good things did happen. See the NASDAQ 100 overshot here, and then we overshot up here as well. Relative to the S&P 500, have not lost this trend line yet, and are still above this upward sloping trend line here. NYSE Composite Weekly stalled, logical area up here, made a stand at a very, very important 200-week moving average here. If we were to come back down, we want to be aware of this weekly gap here. At the end of the week, August 26th, you can still say this looks better than anything that we've seen going back to Q4 of last year. Like many of these charts, more vulnerable, yes. It's really going to matter what happens next. This is not a particularly good look. This is the S&P 500's 10-minute chart. We broke this area here, and you can see we dropped like a stone in that area. We went up very rapidly in that area. Went up very rapidly in that area, and now we're back in that area. That would be the bad news. The good news would be we're still above this upward sloping trend line that goes back to the low on June 16th down here. And this is an upward sloping trend line, so you can make an argument that 3,900, these two lines could intersect if price comes down. So we'll learn something in this area here. Still want to keep an open mind about a bottoming process. How can that be? Well, look where the 10-year yield is at the close on August 26th. It is well below the high that was made way back in June. That speaks to expectations about future Fed policy and inflation. It also speaks to concerns, growing concerns about the economy. But all things being equal, if you're a stock market bull, this lower high is a good look. This is not a good look. The VIX weekly. This was better than anything we had seen going back to Q4 of last year. Closed back above that trend line. That's not really what you want to see. This would be a concerning look. If you're a stock market bull, you wanted this area here to act as resistance. It did. We first popped up earlier this month. We closed well above this area on Friday and are more vulnerable to a push higher. ARKK ARC relative to XLP defensive, the upward sloping trend line of the ratio. Way back in May here, we broke it. That's not really what you want. And if you look at this line here, that goes back to the COVID low. We came back up and tagged that. So the longer we stay in this area here, the more concerning it becomes. Relative to some of the other charts that we looked at, this looks a little more vulnerable than most. Still, for the most part, consolidating in this area, but if we lose this area, that would be concerning for risk in general. Economic and stock market bulls really want to see a look like this in high yield. This is weekly. If we look at daily, we're taking on somewhat of a failed breakout look. Again, not really what we want to see, but it's possible we could still move in this direction. So this is your big risk-on rally in November of 2020. This is small caps relative to the S&P 500. This doesn't really have a risk-off look. This ratio is hovering above the 200-day moving average, and we have this cluster here. So as long as the ratio stays above the moving averages, that look, you can make an argument, looks similar to this period here, helping us keep an open mind about a bottoming process or better than expected outcomes. QQQ relative to SPY held here, held above, kind of a mixed bag and a vulnerable look here. Bulls want to move in this direction, bears want to get into this white space. It's a monthly chart on August 26th. We're still above the 50-month moving average. Very, very similar story with the weekly. At a very, very important juncture near that 200-week moving average shown in red. Like many of the charts we've shown, this would be your bad news look. Your potentially good news look would be that you're coming back to an upward sloping 50-day. We'll learn something about risk in general in this area here. I believe there's 3 more trading days left in August, and here's another very, very indecisive look, but you have to say it's also a vulnerable look. It's only one day, but VGT lost several important short-term areas during Friday's session. XLK looks a little bit better at the close on Friday, August 26th. You're still above the upward sloping trend line for the most part here, and above that upward sloping 50-day in green. Can also make an argument that this is some form of consolidation in this area here. And a lot of whipsaws in 2022. Look at this ratio here. Having trouble making up its mind near the 200-week moving average. It's possible it needs to look like this or like this, meaning it would need to get up into this area here. If you're a stock market bull, you like this look last week better. It looks more like this or this. Again, a lot of short-term indecisive looks. If you're an XLP bull relative to tech, this is nice here because it looks like you've reclaimed these levels, but you haven't reclaimed this upward sloping trend line that you broke, and it's possible this is a retest of breaking that trend line. So somewhat in no man's land in the short run. Is XLY divided by XLP discretionary relative to defensive as of the close on August 26th. This doesn't look too bad. For the most part, it's holding important levels. We wouldn't be saying that if we get into this white space here. We'll see how it plays out. Highly indecisive again here on this ratio, August 26th. You can see where the market has held in the past. You can also see what it looks like here in 2007. So in this segment, we're going to take a hard look at fundamental data to try to answer this question. And when we review this data relative to past recessions, it also helps us understand what to look for if the economy is rolling over in an incredibly concerning manner. And it can also help us walking forward relative to Fed policy, because you can make an argument at some point, the weaker the economy gets, the more prone the Fed will be to pivoting. The information on your screen comes from the National Bureau of Economic Research. They're the body that officially declares when we're in a recession. And according to them, they use a range of monthly measures of aggregate real economic activity published by the federal statistical agencies. And according to their definition, a recession involves a significant decline in economic activity that is spread across the economy and lasts more than a few months. There's 6 main data sets that they use to determine whether or not we're in a recession, and we're going to walk through each of them in detail to see what we can learn about 2022. This is real personal income excluding transfer payments in the 1970s. In each one of these charts, the shaded areas will show you when the U.S. economy was in a recession. Starts right here in 1973, ends here in early 1975. And as we would expect, some type of economic contraction would look somewhat like this during a recession. So let's look at the indicator during past recessions and eventually compare it to the look of the same indicator in the present day. Here's your double dip recession in the 1980s. You can see weakness starts all the way back here and doesn't end until this point here. This is the official window for the 1980 recession. Similar situation over here, but more of a consolidation look during the recession period. A little bit of a decline from point A here to point B here. Our present day situation in 2022 is often compared to the period shown on your screen. And you can see real personal income, excluding transfer payments, experienced a noticeable and significant decline during the recession. Similar situation during the dot-com bust bear market. At some point, the indicator declines in a significant manner. As you might imagine, a significant shift in the indicator during the financial crisis, the 2007 to 2009 window shown here. So ultimately, we'll be asking, how does the present day look of the same indicator compare to these periods? Better, worse, or about the same? Considering the indicator just made a new all-time high here in 2022, better, and noticeably better than the sharp decline that took place during the COVID plunge here back in 2020. If we just zoom in on the present day, which will allow us to make a more direct comparison to this period here, these are monthly data points. We just made a new all-time high just one data point ago here in 2022. Some slowing, but we still have a chart that's moving from the lower left, for the most part, to the upper right. That's significantly different relative to this recessionary period where you're moving from the upper left here to the lower right here. Present day really doesn't look anything like this A to B move, and doesn't look anything like this A to B move. Like everything else, we trade the chart in front of us, and we trade the data set in front of us. We're not using this to predict anything. We're using it to look at the current state of the U.S. economy and try to assess whether or not we're currently in a recession or if we're potentially very, very close to slipping into a recession. Let's go to data set number 2, non-farm payroll employment. You can see here in the 1940s, the data set is declining literally for 2 years before we hit the recession in 1945. So A to B, that's a significant decline. A to B, a significant decline. Noticeable weakness in the 1953-54 period shown here. Same can be said for 57-58 and 60-61. Not as pronounced in these cases, but noticeable here near the end of the recession window, and weakness from here to here in 69-70. Pretty easy to spot the weakness in the 1980s during the double dip period, and significant weakness again in 1990, a period that's often compared to 2022. During the dot-com bust bear market, eventually you get an abrupt reversal, and the financial crisis looks like a scary drop on your favorite roller coaster. How about if we compare the present-day data set to these periods and the COVID plunge? Total non-farm payrolls recently printed a new all-time high. If you look at this closely, you can see the data point is above this thin line here. It's higher than this point here. Thus, it's very, very difficult to say the present state of this data set is screaming imminent recession. It doesn't necessarily forecast anything, but really what we're asking here is, does this data set align with or contradict all of the breadth thrusts that we've been covering in recent weeks? In its present state, it's very, very difficult to say anything other than it seems to align with them perfectly. And let's compare the financial crisis head-to-head to the present day. Once again, always subject to change, but the present day, we're moving July 2021 to the present day from the lower left to the upper right. Quite a bit different from this period here where we move from left to lower right. Next data set, employment as measured by the household survey. Discernible weakness in 1948-49 and 53-54. Same can be said here, 57, 58. A little more muted here. This doesn't look as bad. Still have somewhat of a decline look here. Nothing earth-shattering here, but eventually some noticeable weakness. Some noticeable weakness during the recessionary period. Easier to discern in the double dip period. Same can be said for 1990, 1991. The weakness starts before the recession window. We can clearly see it. It doesn't really end until after the recession window. If you're a little more adventurous, you can put your hands in the air here as we decline. And if you like elevator shafts, you'll enjoy this move here in 2020. Having said all of that, doesn't look too bad yet in 2022. A little bit of a stall look, but not that much different than what we see over here. It's very, very difficult to say the present day looks anything like this period from point A to point B, given for the most part we're still lower left, upper right. Next up, data set number 4, real personal consumption expenditures. In its present form, only have data going back to 2002, but still helpful. You can see during the financial crisis a significant decline. Waterfall during COVID, and a recent new all-time high was made in April of this year. Late 2007 here, during the final leg down in the financial crisis bear market, a discernible drop from A here to B here. Just quite a bit different relative to the chart in front of us in 2022. If we go back to May of 2020, here's point A, here's point B. Is it possible that all of these data sets are about to roll over? We know the answer. It's absolutely positively yes, and it may happen very, very soon, but it hasn't happened yet. Data set number 5, wholesale retail sales adjusted for price changes. Discernible drop, double dip drops, significant decline in the 90-91 period. If you know your stock market history, you know the S&P 500 peaked in March of the year 2000, but the bear market really started in earnest from this point here in September of 2000, and this is where we move from A to B. Another Six Flags data set from the financial crisis. Elevator shaft in 2020, and some discernible weakness in 2022 from point A here to point B here, but not all that bad. It looks more like consolidation currently, but no question more vulnerable to a rollover. Data set number 6, industrial production. Have data going way back in this case. How does the present day compare to the 1929 to 1933 period shown on your screen? We're going to find that out soon. In this window here, the Dow Jones Industrial Average lost approximately 89% of its value. That's correct, 89%. So we can call this one of the big four. Here's two of the big four, the 1973 to 1974 bear market, because the low comes in 1974. It's very, very similar to the dot-com bust and the financial crisis relative to the magnitude of the drop. Pretty clear to see here. In 1973, we moved from point A to point B down here in 1975. 3 of 4 of the big drops, very, very early here. For the most part, in the year 2000, from this point here, we move from point A to point B. 4 of 4 of the big four. This is late 2007. The S&P 500 peaks in Q4 of 2007, and a very discernible decline in industrial production. Thus, how does the present day compare to 1929 to 1933, 73-75, 2001 recession, 07-09 window? Better, worse, or about the same? The answer is much, much better. During the recession, upper left to lower right, upper left to lower right, upper left eventually to lower right, upper left to lower right. Present day, lower left to upper right. You can see here, if we compare the present day to the dot-com bust bear market here, financial crisis here, and the COVID elevator shaft plunge here. It really doesn't look anything like this. It really doesn't look anything like this. And it really doesn't look anything like this. In fact, in 2022, this indicator just printed a new all-time high, breaking above this level here, and this level here that dates all the way back to 2007. In fact, this data set seems to align nicely with the longer-term secular bull market thesis driven by demographics. The longer the economy is stagnant, 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 the bigger the move that you can expect to get if you get a bullish breakout or bearish breakdown. In this case, a bullish breakout, a bullish breakout, a bullish breakout in the 1990s, and an attempt here in the present day at a bullish breakout. Very, very difficult to say that this chart really looks anything like these periods marked by economic contractions in the United States. As always, we're talking about the data set in front of us. We're not making a prediction in any shape, form, or fashion. This is just helping us answer the question, what are the odds that the U.S. economy is currently in a recession and/or about to enter a recession, or maybe even 3? How likely is it that sometime in the next few days or few weeks that the National Bureau of Economic Research is going to declare a recession? Well, that's to be determined, but a new all-time high doesn't sound particularly bearish from a probability perspective. If we look at all of the data sets on one graph going back to the beginning of the year here, you can see what we've already seen, that manufacturing is really the only data set in the economy that looks vulnerable or has been weak in recent months. Here's your baseline right here. The other 1, 2, 3, 4, 5, based on the data set and chart in front of us, this looks pretty good from an economic perspective. And if we consider this straight from the horse's mouth, in recent decades, the two measures we have put the most weight on are real personal income less transfers and non-farm payroll employment. Real personal income less transfers just made a new all-time high in April of 2022, and non-farm payroll employment just printed a new all-time high in 2022. Doesn't predict anything, just helps us better understand the probability of good things happening relative to the probability of bad things happening. Let's take a look at the same basic concepts, but this time let's look at a data set from the Federal Reserve Bank of Dallas. It's a composite index of recession indicators, straight from their website. Our index, which begins in 1959, declined from the peak point in every previous recession. By comparison, the index steadily rose from December 2021 to May 2022 and was unchanged from May to June of this year. Very similar concepts. This really doesn't look anything like this, and this really doesn't look anything like this, and this, in its current form, really doesn't look anything like this. Another way to look at the same concepts from the Washington Post, you can pause your video player. We're comparing the present day here to the last 6 recessions, and they exclude 2020 because of the elevator drop. It's a little bit unique and different. Probably fair to draw the same conclusion based on what we know today. Doesn't look particularly alarming. And if we look at one of the most recent data sets, this is a MarketWatch article dated August 25th, no sign of surging layoffs. You can pause your video player, or better yet, Google this title here to find more information. Bullet points over here come from Invesco. Source is a MarketWatch article dated August 22nd. 3 reasons why the Fed might pivot to a less hawkish stance. Notice it says less hawkish. Doesn't say dovish. Speaks to a slowing economy up here. We have a couple of reads recently saying that long-term inflation expectations, something the Fed is concerned about, have calmed down a little bit. And we do have evidence in hand telling us it's quite possible that inflation may have already peaked or maybe peaking in the next 2 to 3 months. You can pause your video player here. Used vehicle prices right here. Quote from Bernstein: "We are now just 2 months away from used car prices, as measured by Manheim, being down year over year for the first time since April of 2020. We'll start hitting year-over-year CPI in a good way shortly thereafter." Do these concepts align with or contradict all of the breadth thrust data that we've covered in recent weeks? Here's a research piece on the left side of your screen. Here's the source. It's within the realm of possibility that CPI, or the Consumer Price Index, could be cut in half relative to the last reading between now and, let's say, the end of the year or Q1 of next year. Fed policy, interest rates, and maybe more importantly, inflation data walking forward will be immensely important. There are undoubtedly a lot of things to be concerned about, and even a lot of things in the short term to be concerned about relative to what's transpired over the past 5 or 6 trading sessions. Having said that, there's always another side. Right now, these signals, for the most part, are still intact. Very vulnerable, yes, but still intact. And if you know your stock market history, look at this quote here and then think about what happened after this period and this period and this period. Typically, harder markets are followed by much easier markets. We're not there yet, but at some point, we'll get there. The concept of a bottoming process with a score of approximately 50 is definitely alive and well. Most likely what we're looking at here, are we under more of a retest scenario where the original low holds? That would be the 2003 case. This is a traditional and classic retest where you make a higher low. Or are we looking at something more like Q4 2008, Q1 2009, where it's still part of a bottoming process, but you make a significantly lower low? I also have to be aware here, with the economy this strong, the Fed probably feels that it can afford to continue to raise interest rates. And history tells us in a leveraged society, something may break at some point. Typically, when something like that happens, you're looking more at another serious leg down. Don't really have anything like that yet. Can't hurt to be prepared mentally. In terms of the breadth thrust and the historical drawdown levels, more vulnerable? Absolutely, positively, yes. Have we seen enough to throw them out the window? Not yet. We showed a lot of charts this week that are in short to intermediate term no man's land, and either the support that we have relatively close by is going to hold, or it's possible we're going to take a whole nother leg down, which means additional risk reduction is also possible. And really nothing new here. Even with all of the breadth thrusts in hand, we entered this week making no assumptions about anything. Probably going to learn a lot about the risk-reward ratio of this market in the next few trading sessions, next few weeks, next few months. Thus, we all know the only way any of this can work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.